The baseline reality of global capital markets is a paradox. Highly resourced funds managing billions of dollars consistently fail to beat standard market indexes. The statistics for the average individual are even worse. The single best-performing mutual fund of the 2000s returned an astonishing 18% per year, yet the average retail investor in that exact same fund managed to lose 11% annually, completely eroding their capital through mistimed buying and selling. The standard academic explanation for this is the efficient market hypothesis. If prices perfectly and instantly reflect all available information, attempting to outsmart the collective wisdom of thousands of professional analysts is mathematically indistinguishable from a coin flip. But at Columbia Business School, investor Joel Greenblatt presents a much harsher reality to his students. He warns them that their raw intelligence, elite education, and access to massive institutional resources will not prevent them from underperforming. The barrier to generating excess returns is not a lack of computing power or superior information. Professional capital is hindered by mathematically fragile valuation models, the built-in flaws of passive indexing, and severe institutional liquidity constraints. To beat the market, an investor must decouple their capital from the mechanics binding the institutions. The foundational axiom of intelligent capital allocation comes from Benjamin Graham. You calculate the intrinsic value of an asset, and you acquire it at a significant discount, creating a mathematical margin of safety against error. This chart shows the primary tool Wall Street uses to find that value, the discounted cash flow model. It projects all the cash a business will generate over its lifetime and discounts it back to today's dollars using a risk-free rate. If a business generates a steady $10,000 a year, a 6% discount rate calculates the present value of that asset at roughly $166,000. But those future cash flows are not guaranteed. If an analyst adjusts the discount rate to 12% to account for higher business risk, the present value reacts violently, plummeting by half to $83,000. If we introduce a variable for long-term growth, the math becomes entirely untethered. A minor 1 or 2% adjustment to a 30-year growth estimate causes the final valuation to swing violently between $100,000 and $500,000. Standard valuation models project an illusion of precision. Attempting to forecast macroeconomic conditions and corporate earnings 3 decades into the future is an exercise in guesswork, built on deep epistemological flaws. To bypass the fragility of 30-year forecasting, institutional analysts rely on 3 alternative valuation frameworks. Relative value prices a company directly against its peers. If an entire sector detaches from economic reality, like internet stocks during the dot-com bubble, buying the cheapest asset in a vastly overvalued neighborhood still guarantees a loss. Acquisition value estimates the premium a strategic corporate buyer would pay. This relies on theoretical synergies, like merging redundant operations, that routinely fail to materialize in actual corporate execution. Liquidation value calculates what an asset is worth if management shuts the doors and sells the inventory. In practice, entrenched executives will drain a company's remaining cash to preserve their own salaries long before they voluntarily liquidate. Relying on any of these standard institutional tools embeds systemic failure risks directly into the capital allocation process. Rather than attempting to predict the distant future, Greenblatt engineered a comparative heuristic, benchmarking potential investments directly against the known immediate yield of a U.S. Treasury risk-free rate. This graph illustrates the mechanics of the framework. The first metric is earnings yield, operating profit divided by enterprise value. It tests whether a company's current proven cash generation significantly exceeds the risk-free rate. The second metric is return on capital. This acts as a proxy for business quality, measuring exactly how much profit the underlying business generates for every dollar of capital it deploys. By plotting these 2 variables together, the heuristic systematically isolates a specific class of assets, companies that are simultaneously statistically cheap and highly capital efficient. This 2-factor approach evaluates the actual mechanics of a business today, mathematically bypassing the fragile assumptions and extensive guesswork required by long-term forecasting. For passive capital, the default investment vehicle is the market cap weighted index, like the S&P 500. This pie chart demonstrates the defining mathematical rule of market cap indexing. The percentage of capital allocated to any single company is tied directly to the total market price of its outstanding shares. When a stock's price surges completely detached from its economic fundamentals, the index is automatically forced to buy more of it. Conversely, as an undervalued asset drops in price, the index sells it off. The architecture of a standard index embeds an automated momentum bias. It mathematically guarantees that capital will be misallocated during extremes of market psychology, systematically buying high and selling low. Equal weighting indices attempt to fix this by giving every company the exact same allocation. While this neutralizes momentum bias, it blindly forces equal capital into clearly suboptimal, low-quality businesses. Fundamental weighting improves on this by allocating capital based on a company's actual economic footprint, like sales or book value, which consistently outperforms price-weighted indices over time. A value-weighted index goes further. It takes the largest 1,400 companies and ranks them strictly using the earnings yield and return on capital heuristic, actively overweighting the top deciles. This chart details a 20-year backtest. The value-weighted architecture yielded 13.9% annualized, transforming an initial 10,000 into 135,000. Over the same period, standard indices yielded roughly 7.6%, leaving the same initial capital at just over $43,000. Abandoning price weighting in favor of value weighting systematically captures a massive, historically proven premium. If a value-weighted architecture so thoroughly outpaces standard benchmarks, the obvious question is why professional money managers refuse to utilize it. The first constraint is capital mass. A fund managing billions of dollars mathematically cannot allocate meaningful capital to a sub-$1 billion company without breaching regulatory limits or destroying the stock's liquidity upon exit. They are too large to fit through the door. The second constraint is career risk. Institutional managers are judged on tight quarterly benchmarks. Deviating from standard indices into a value strategy that temporarily underperforms the broader market carries severe termination risk long before the strategy pays off. The third constraint is client behavior. During severe market troughs, panicked clients demand cash withdrawals, forcing the manager to liquidate their best positions at the worst possible prices. The institutional deficit in generating alpha is not an intellectual problem, it is a mechanical one. Wall Street is legally and structurally constrained from optimizing capital. These constraints leave specific submarkets completely open for unconstrained capital. Consider special corporate situations, like a conglomerate executing a spinoff. Institutional mandates frequently prohibit managers from holding these unrated, complex new shares. As a result, massive institutional funds are forced to indiscriminately dump the new equity immediately, creating extreme downward pricing pressure independent of the underlying asset's fundamental economic value. These inefficiencies are then multiplied by human psychology. Fundamental macro forces like credit expansion and contraction are violently amplified by behavioral biases, specifically loss aversion during contractions and herd momentum during expansions. The market aggregates human emotional exaggerations. Exploiting these inefficiencies requires systematic rules designed specifically to bypass behavioral impulses altogether. For the unconstrained investor, survival and outperformance require binding capital to a strict operational framework. The first parameter is establishing a rigid asset allocation target. You determine the exact percentage of capital committed to equities, and you refuse to alter it in response to external market noise or economic headlines. The second parameter dictates how that capital is deployed. As John Maynard Keynes established, you apply highly concentrated, conviction-based capital allocation, utilizing value-weighted indexing or disciplined quantitative heuristics to bypass momentum traps. The third parameter is mechanical rebalancing. You adjust the portfolio to its target allocation strictly on an annual basis, locking in gains and buying discounted assets without allowing daily emotional volatility to interrupt compounding returns. This mechanical rigidity is the only mathematical defense against the momentum biases and behavioral amplification that consistently destroy retail portfolios. The advantage of the unconstrained investor does not come from possessing faster algorithms or superior insider information. The advantage is structural freedom. It is the freedom to avoid the automated momentum bias of market cap indexing and the freedom to completely ignore the quarterly benchmark noise that dictates institutional behavior. By leveraging a long-term horizon and mechanized discipline, the unconstrained investor captures the premium generated by the structural constraints and behavioral errors of professional capital.